looking to purchase home or refinance and wondered if paying points is right for you? For years, points have gotten a bad rap by the public because they were previously used inappropriately. But when used correctly, points can be a humongous advantage for a buyer or somebody looking to refinance, and they could save you thousands in interest over the life of the loan. But like anything, there's a time and a place. So I'm gonna dive into what points are, how to use them, when to use them, and hang on at the end because I'm gonna share a pro tip on how to get the seller to pay for your points. So what is a point? A point is typically prepaid interest equal to 1% of the loan amount. So if your loan amount is $400,000, 1 point will equal $4,000. Now, there are two basic categories of points. There are loan origination points and discount points. A loan origination point is a point or fee that is added to the closing cost of the loan for the origination process of your mortgage. It does not benefit you by decreasing your interest rate. In this case, a loan origination point, you are basically paying fees for the processing and underwriting of your mortgage. This is not optional and is often mandated by the lender. A loan discount point is a point, or again, 1% of the loan amount, which is prepaid interest, that allows you to buy down the interest rate on the mortgage. So you are paying an extra closing cost or prepaid interest to get a lower interest rate over the life of the loan. Look at it as an investment, not a cost, because this investment is going to help you decrease the interest rate and therefore decrease the amount of interest that you are paying over the life of the loan. Typically, one discount point is going to reduce the interest rate on the loan about 0.25%, but that'll depend on the size of the loan, the type of the loan, and the lender that is offering the mortgage. So let's run through an example to see what one discount point would save you on a $400,000 mortgage. So first, we have a $400,000 mortgage at 8% spread out over 30 years. The principal and interest payment on this without a discount point is going to be $2,915 per month. Now, let's say you opted to pay a discount point. So it'd be a $400,000 mortgage with one $4,000 discount point, reduces the interest rate to 7.75, which will make the principal and interest payment $2,847 a month. This will save you $68 a month. Now your break even on that, if you divide $4,000, which is your initial investment, by $68 a month, you are breaking even in a little under 5 years. So if you plan to have this mortgage for 5 years or more, this investment mathematically made sense for you. Now let's look at this over the life of the loan, because this is where the big savings come into play. Over time, that discount investment will save you about $25,000 in interest over that 30-year amortization. So if you had a crystal ball and you knew that you were gonna have this one mortgage for 30 years, this investment absolutely would make sense for you. Hopefully that example helped illustrate the pros and cons of paying points, but just in case, let's review them. Obviously, the pros are reducing your interest rate, reducing your payment, and reducing the interest that you're gonna pay over the life of the loan. Conversely, the cons are that it is more expensive up front, and this is what keeps most people from paying discount points up front. Remember that when you purchase a home, you should budget another 1.5 to probably 3.5% of your purchase price at the closing table. So if you're going to add a discount point on top of that, it's going to make that number somewhere around 2.5 to 4.5% of the loan amount when buying a home. So it'll drastically increase the closing costs that are due at the time of closing. The second con is that it takes time to recap that investment. Like any good investment, it's gonna take some time to see the benefits. In the example that I gave you, it's gonna take you a little under 5 years to actually see the benefit of making that discount point investment. And the last con, and this is a big one, is if you do not keep the loan for the time it takes to recoup your investment. So in the example that I gave, if you do not have your loan, which means if you refinance or sell the house and you pay off the mortgage, before that 5-year term, you will actually have lost money. So when you are considering whether you want to pay a discount point or not, it's important to really understand how long you plan on being in that home. The piece that you cannot know is if you will refinance down the road or not. If you are in a market where rates are likely to decrease, there's a pretty good chance you're going to want to refinance and get a lower rate. So if you refinance, in my example, if you refinance before that 5-year mark, you will likely have cost yourself some money. Now I'd like to share my idea on how you can get the seller to pay your discount point for you. Before I do that, do me a favor, tap that like button, hit the subscribe button for more videos just like this one. Okay, so typically when you buy a home, you're going to have a home inspection. Not every house is perfect, most of them aren't. You're gonna want the sellers to fix some things for you. Instead of asking them to fix those things for you, ask them to give you a closing cost credit, which then you can use to buy down your interest rate. So let's use an example. Say when you're doing your home inspection, there's roughly $4,000 of things that you want the seller to fix. Instead of asking them to do those repairs for you, ask them to give you a $4,000 closing cost credit, which then you can apply for a discount point to buy your interest rate down, therefore saving you maybe hundreds of dollars a month or thousands over the life of the loan. Thank you so much for watching.